You saw the headline about silver prices falling. You read about technical correction and profit taking. But the real story wasn't in the headlines. It was buried in regulatory filings and corporate credit lines, and in a funding chain that silently ruptured in November 2025. Silver didn't fall because investors lost faith. It fell because $31 billion in funding vanished from the structure supporting the physical market. And when money dries up, gravity always wins. It doesn't matter how much you believe in the metal. What matters is who can pay to move it, store it, and finance it. While analysts debated charts and moving averages, a mechanical collapse was underway. 3 major investment banks simultaneously cut their credit lines to precious metals traders, not because of fear of silver, but because their own balance sheets were under pressure from regulators demanding more Tier 1 capital after the regional banking crisis of March 2025. The effect was instant and brutal. Traders operating with 10.1 leverage saw their positions liquidated within hours. Futures contracts were force closed. And most importantly, physical demand for industrial silver evaporated because nobody could finance inventories. Factories bought only hand-to-mouth, zero buffer, zero speculation. Here's what the data shows. In October 2025, registered inventories at COMEX stood at 285 million ounces. By December, they dropped to 198 million, a 30% decline in 8 weeks. But the price didn't rise with scarcity, it collapsed. Why? Because there were no buyers with available capital to absorb the physical metal. The silver market has always been an illusion of liquidity. For every ounce of physical metal, there are 250 ounces in paper contracts. And these contracts depend on an unbroken chain of credit. Banks financing traders, traders financing refineries, refineries financing miners. When one link breaks, the cascade is inevitable. And 31 billion isn't a link. It's the backbone. Silently, while everyone watched gold, 3 Latin American silver miners canceled capex expansions planned for 2026. Not because the projects weren't viable, but because the banks that should have financed these expansions were busy covering their own exposures. Capital fled to treasuries, to liquidity, to safety. Silver was orphaned. The mechanics of the collapse has a name: margin call cascade. When prices begin falling, leveraged traders receive margin calls. To cover these calls, they sell more silver. The selling pressures the price further down. New margin calls emerge. The loop feeds itself until all leveraged positions are eliminated. In November 2025, this loop lasted 72 hours. Billions were vaporized. But there's something deeper happening. Silver has always been the hybrid metal, half industrial, half monetary. And in 2025, the industrial side died first. China, which consumes 25% of global silver for solar panels and electronics, reduced its imports by 18% in the second half, not from lack of solar demand, from excess of poorly financed inventories. The numbers don't lie. The Shanghai Futures Exchange reported a 40% drop in silver contract volume between September and December 2025. At the same time, spreads between physical silver and futures exploded to 280 per ounce. This isn't volatility, it's structural dysfunction. It's the signal that the price discovery mechanism is broken. Meanwhile, behind the scenes, something even more sinister. The large institutional players dominating the silver market began using the metal as collateral for other operations. Pledged silver became shadow collateral in repurchase agreements. Physical metal started circulating in rehypothecation chains, where the same ounce is used as guarantee in 3 or 4 simultaneous transactions. When credit dries up, these chains collapse like dominoes. The irony is brutal. Silver is sold as a hedge against financial system collapse, but it depends on that very system to function. Without banks willing to finance inventories, without traders with access to credit, without liquidity in futures markets, silver becomes just a heavy and expensive metal to store. The romantic narrative meets mechanical reality and loses. Retail investors continued buying coins and bars. They saw the price drop as opportunity. But what they didn't understand is they were buying an asset whose price is determined by wholesale financing structures. Their demand of $500 or $5,000 doesn't move the market. What moves it are credit lines of hundreds of millions. And those lines were cut. Now observe the official narrative. Technical decline. Seasonal profit-taking. Portfolio realignment. All true, all irrelevant. The technical truth is that a $31 billion funding shock created a forced liquidity event that massacred all leveraged long positions and destroyed the forward price curve for 2026. This isn't correction, it's structural capitulation. And the regulators? Absolute silence. Because acknowledging the fragility of the commodity financing system would be acknowledging the problem is systemic. That the same leverage and rehypothecation mechanisms that broke the housing market in 2008 are alive and operating in metals markets. Only now they're more opaque, more complex, and more global. The lesson is simple but brutal. Physical commodities need physical money to move. And when that money disappears, gravity acts. Fundamental demand doesn't matter. Structural scarcity doesn't matter. If If there's no financing to carry inventory from mine to factory, the price falls, always, without exception. The confrontation is now clear. On one side, the narrative of safe haven and inflation protection. On the other, the mechanical reality of a market dependent on bank leverage and credit lines. And in 2025, reality won. The old model of commodity financing via large banks is dying. The new model hasn't been born yet, and in that vacuum, chaos reigns. But there's an even deeper layer. The $31 billion didn't disappear. It migrated. Where to? To assets with guaranteed yield, to government debt, to credit structures with explicit backing from central banks. Silver competes for capital. And in 2025, it lost that competition spectacularly. Institutional investors chose 5% risk-free instead of volatility in a yieldless metal. The technical signals were screaming for those who knew where to look. Open interest at COMEX plummeted 35% in 6 weeks. Silver ETF volume dropped to 2-year lows. And most revealing, the spread between silver and gold exploded to 95.1, the worst level since 1991. This isn't just relative pricing, it's institutional abandonment. And then came the final blow. In December 2025, Switzerland's largest silver refinery announced it was operating at 60% capacity due to lack of economic demand. Translation: there's no credit available to finance the conversion of ore concentrate into refined bars. The supply chain stopped not from lack of metal, but from lack of money. What happens now? 2 possibilities. First, the financing system rebuilds on more conservative bases, with less leverage and wider spreads. This means chronically suppressed prices and brutal volatility. Second, new players enter with different capital structures, perhaps backed by wealth funds or family offices that don't depend on commercial banks. But that takes years. Meanwhile, silver remains in no man's land, too expensive for industrial use without cheap financing, too volatile for conservative investors, too illiquid for serious institutional trading. It's the orphan asset of 2026. And atoms don't lie. Without capital flow, there's no price, just dead weight in vaults. The truth nobody wants to admit is that physical commodities are, in essence, logistics and financing businesses. The metal itself is secondary. What matters is who has credit to move it, store it, and assume price risk. And in 2025, that who decided silver wasn't worth the cost of capital. Game over. Investors who didn't understand this are now sitting on 40 to 60% losses depending on entry timing. They believed the narrative. They ignored the mechanics. And the market taught capitalism's oldest lesson. Narratives don't pay margin calls. Cash flow pays. And when flow dries up, no beautiful story sustains the price. The next chapter is already being written. Silver miners are cutting production, not because mines are exhausted, but because they can't finance operations at current prices. This supply cut will eventually create real scarcity, but it may take years. And meanwhile, the price can fall further because industrial demand is also dying. It's a race to the bottom. Here's the final warning. If you own physical silver, not as investment, but as insurance, you're protected. The metal is with you. But if you own silver in ETFs, futures contracts, or custody certificates, you're exposed to counterparty risks that exploded in 2025. The difference between claims on silver and physical silver has never been greater. And in a liquidity crisis, that difference is the difference between solvency and ruin. The world changed silently in November 2025. A $31 billion funding shock wasn't news. It had no dramatic headline, but it completely reconfigured the structure of the silver market. And now, while prices remain depressed, the true cost is being revealed. Canceled projects, closed mines, broken supply chains. The consequence will come, but not when the bulls expect, and not in the way they imagine. Look at the derivative exposure. JP Morgan, the largest player in silver derivatives, quietly reduced its notional exposure by $8.2 billion between October and December 2025. Not because of market conditions, but because Basel III endgame rules made holding those positions prohibitively expensive from a capital perspective. When the biggest player exits, the entire market architecture shifts. The implications ripple outward. Smaller regional banks that provided working capital to mid-tier silver traders found themselves unable to roll over credit facilities. These traders, operating on razor-thin margins, couldn't maintain inventory positions. They became forced sellers. And in a market already suffering from liquidity stress, forced selling creates price dislocations that feed on themselves. What the mainstream missed was the connection to the broader commodity finance crisis. Silver wasn't unique. Copper financing in Asia faced similar stress. Aluminum warehousing credit dried up in Europe. The entire commodity finance ecosystem was undergoing a violent deleveraging. But silver, with its smaller market size and higher volatility, suffered the most extreme moves. The timing was catastrophic. Just as industrial demand from the solar sector was set to accelerate in 2026, the financing infrastructure to support that physical demand collapsed. Panel manufacturers in China and India couldn't secure letters of credit to import silver. Projects stalled, orders were canceled. The fundamental bullish thesis remained intact, but the mechanism to realize that thesis was destroyed. Consider the warehouse dynamics. London Metal Exchange approved warehouses held 850 tons of silver in September 2025. By year-end, that figure dropped to 320 tons. Not because of consumption, but because warehouse operators couldn't secure the credit lines needed to finance storage operations. Physical metal sat in non-LME facilities, effectively removed from the tradable market. The options market told its own story. Implied volatility on silver options exploded to levels not seen since the March 2020 pandemic crash. But this time, the volatility wasn't pricing uncertainty about the future. It was pricing the present reality of a broken market structure. Market makers widened bid-ask spreads to 15-20 basis points, making profitable trading nearly impossible for anyone but the largest institutions. And then there's the mining sector's response. Major producers like Fresnillo and Pan American Silver announced they were curtailing output at their highest cost operations. But here's the twist. These weren't marginal mines. These were facilities producing at $18-19 per ounce all-in sustaining costs. With spot prices at $22, they should have been profitable. But without forward hedging programs, which require credit lines, they couldn't lock in prices. Uncertainty killed production. The junior mining sector faced extinction-level pressure. Exploration budgets were slashed by an average of 65% across the sector. Without access to equity markets or project financing, dozens of promising silver deposits will never be developed. The supply deficit everyone predicted for 2027-2028 just became structurally guaranteed. But the price today reflects none of that future scarcity. Capital has no feelings. It has destinations. And in 2025, its destination didn't include silver. Those who didn't understand this basic mechanic paid the price. Those who still don't understand will pay again. Because in the end, the market always teaches. And the lesson is always the same. Respect capital flow or be crushed by its absence.